Is DeFi dead?
That is a tricky question. If you hold ETH or a BTC and you believe they will go up in a 5-10 year time period, it's better for you to borrow against your ETH or a BTC instead of selling your ETH and BTC and then buying the property with cash. Maybe people are a bit fed up with the meme coins. Maybe it's time for something better.
What would you say to people who are a little bit jaded by the crypto space right now? I've been working with the Token.com team for almost a year now, and I want to share their new product with you all. If you've traded or own any Token.com token, drop your wallet address in the comments for a chance to win up to $500. I'll pick 5 lucky winners. Join the Token community on Telegram, follow them on Twitter, Instagram, and TikTok, and subscribe on YouTube to join in more competitions to win and earn Token. Awesome. Today we're here with Altitude Finance. We're super excited to talk about them and kind of the resurgence of real products and DeFi. But I want to start off with a bit of a tricky question. Is DeFi dead? Why or why not?
That is a tricky question. I think it kind of depends in which echo chambers you are. I tend to hang out in kind of the Ethereum ecosystem. Mm-hmm. There, I think definitely the vibe is that ETH is dead. So does that make DeFi on Ethereum dead? I don't know. I personally believe that kind of my long-term vision is that that all valuable assets in the world will be tokenized. And so I think DeFi plays a very important role in that, right? So DeFi allows you to tokenize, allows you to borrow against it, allows you to do all kinds of great things. So in that sense, I don't think DeFi is dead. I think DeFi is just getting started.
Yeah, and really, I was surprised. I forget exactly what I tweeted, but I tweeted a couple of days ago about something to do with pump fun and meme coins. And I was surprised to hear so many comments that were like so anti-meme, anti-pump fun. Because obviously pump fun has been this massive narrative. And I remember I actually tweeted in the spring against kind of meme coins, and everyone I got a lot of hate for that. So to see that kind of flip of sentiment against pump fun and kind of like the meme coin game, I think is an interesting turning point in the cycle, and it could be promising for kind of like the resurgence of the DeFi ecosystems.
Yeah, maybe people are a bit fed up with the meme coins. Maybe it's time for something better.
Let's hope so. Cool. So you've got a really interesting product. I think it addresses a need that I actually personally have a unique kind of personal relationship to, but I'll let you explain your product yourself. What is Altitude? What do you guys do?
So we're a loan optimizer on the Ethereum blockchain. And so we optimize collateralized borrowing. We do it in 2 ways. We find the cheapest lending provider. And then we optimize the unused credit line of the user. So let's say you borrow 30% loan to value, then we will borrow an additional 30% on your behalf. We generate yield with that, and then we use that to reduce your interest.
Okay, so I want to break this down to kind of the simplest level, and I think maybe perhaps starting with like the way a conventional lending platform works is the best way to do it. And then we can kind of elaborate on the differences. So that's basically like a traditional lending vault would be, I deposit 100 USDC or 100 ETH into a vault, and then I can borrow up to a percentage of that. And if the price of that asset falls, I'm liquidated and that position no longer exists. Otherwise, I have the original position in the vault, and then I have the money that I can take and do other things with. Is that the case?
Yeah, 100%.
So then what are the specific optimizations Altitude makes?
Yeah, so the biggest optimization is that let's say you've deposited $100 worth of ETH, and then you borrowed $20 worth of ETH. You borrowed $20 USDC. Mm-hmm. Then what happens is that $20 of USDC it keeps accruing interest. So the $20 will become more over time, right? Mm-hmm. As you'd expect. What Altitude does is that it looks at that position and it borrows an additional $40 on your behalf, it deploys that into yield farming at a much higher rate than what we're borrowing it at, and it uses the interest it generates in those yield farms to reduce your original loan. So then that $20 will actually go down over time.
Hmm. So it's kind of in a way, it's a self-repaying loan.
Yeah, yeah, exactly. Yeah,
Okay.
yeah,
So again, I think the reason kind of conventional lending platforms work the way they do is because they're really trying to kind of eliminate risk from the ecosystem. You guys are optimizing for another dimension, which is the ability to be capital efficient. But this introduces a new component of risk, and that's the element of depositing into another protocol and earning yield on those assets. How do you mitigate this risk, and why is it an optimization that you guys see as kind of healthy for the lending ecosystem?
yeah. Gotcha. Yeah, so I think what we're trying to solve is that is kind of the balance between the risk of liquidation and the capital inefficiency. So if you want to if you want to get the most out of your capital, you could deposit it into a lending platform, and then you could borrow at a, let's say, a quite aggressive loan to value, like let's say 40-50%. Then that you're relatively protected against liquidation, because you can sustain like a 30% drop, and you have enough capital to play with. Now, what we're doing is, if you borrow with altitude, and let's say you borrow, instead of at 50, you borrow at 30% loan to value, you've even further reduced the risk of you getting liquidated yourself. But now it's less capital efficient. So you're kind of trading one for the other. So you're adding on a little bit of risk. I'm not going to deny that. What we try and do to minimize the risk is that we only deploy in protocols where we've done our due diligence. So we only deploy into blue chip protocols that have been around for a long time. So we've got an integration with Pendle, we've got an integration with Curve, we've got an integration with the Morpho vaults. So those are a few of the examples.
Uh, there's a whole other sector of the industry which is kind of like under collateralized lending. You guys obviously aren't quite at that point, but you are less collateralized than blue chips to kind of or you enable superior capital efficiency to kind of like more blue chip protocols. Why did you guys not go to this? If you're solving this problem around capital efficiency, why would you not move directly to the under collateralization route? Why do you prefer to optimize kind of the traditional lending model?
Yeah. It's a great question. So I think they're both kind of borrowing, but they're fundamentally different types of borrowing. So over collateralized borrowing, you don't need a trust relationship with the borrower. The borrower provides more capital than he borrows, so you know that your loan is always safe. There's always the at the point of liquidation, the loan kind of is repaid. So you don't need to trust the borrower. Under collateralization is you need to trust the borrower, and you can do a lot of research to verify this. You can obviously look at income statements, balance sheets, all those kind of things to gain more trust that borrower will pay his loan back. But ultimately, there's a trust element, and so we decided to kind of focus on a pure kind of DeFi innovation. So not kind of not having to trust the borrower, but optimize the current over collateralized lending.
Do you think under collateralized platforms have the potential to be successful, or in a kind of like adversarial on-chain environment, is it kind of something that you don't see as particularly viable long term?
I think under collateralized credit is a massive, massive market, and I think there's a lot of benefits of getting that on chain instead of just leaving it to TradFi. So I think it will be very. I think it's a very big market. So I think both types of borrowing cater to a different type of borrowing need, and so I think both of them can be really powerful.
Right. So I mentioned that I have kind of a unique relationship to this product specifically, and it's because I live or I spend most of my time in Mexico, and I'm curious about purchasing real estate in Mexico. At the same time, I hold all these crypto assets, right? So I have long thought about the best way to uh, earn yield and not sell my crypto that I imagine will appreciate immensely in coming years, and be able to purchase real estate, in my case, in Mexican pesos. So why should I, as a borrower, use a platform like yours?
Yeah. Like it depends on what your alternative is, right? So what in this case, like if like what would what would be your alternative to borrowing through Altitude?
That's a great question. Well, I have a kind of a couple things that I face. The first one is a loan. There are loan providers that target to foreigners who live in Mexico. The problem with this is like interest rates are maybe 9, 10, 11, 12, or 13%. So very, very high loans. The other possibility I have is kind of like borrowing or buying something in cash, which is something, despite it not being very capital efficient, I've still considered because it it just simplifies the process. I don't have to kind of manage all these things.
Yeah. Yeah. Okay. Gotcha. And in the first example, are you taking is that a mortgage against kind of salary, or is it also against assets?
I mean, I think they vet you as a borrower, but they also have a claim against the property itself.
Yeah. Yeah. Okay. Gotcha. Gotcha. Yeah. So I think in the second example that you gave, just buying cash. Um, it depends on your outlook on your assets, right? If you own assets that you think will appreciate over time, then it would be financially beneficial to you to hold on to those assets, and borrow against it. And so if you hold ETH or a BTC and you believe they will go up in a 5-10 year time period, then it's better for you to borrow against your ETH or BTC, instead of selling your ETH and BTC and then buying the property with cash. So that's the main benefit that you get if you borrow against your BTC or ETH. You don't have to sell it, and you get the appreciation. Now with ETH, you also get the staking rate, so it actually appreciates 3% per year, or you get more ETH around 3% per year. Um, and then if you use specifically Altitude, if you can get to a loan to value where it's like, so at the current market rates, if you borrow at, let's say, 30% loan to value, then your interest rate is zero. If you borrow at around 20% loan to value, your interest rate is minus 7%. So that means it will take like between 9 and 10 years for that entire loan to be paid back. So then after 10 years, you have your house and you still have all your ETH or BTC. That's obviously a much better scenario than if you just had your house. However, it does require for ETH and BTC to keep going up. So that's the view that you need to take personally. Do I think ETH and or BTC or whatever collateral asset you want to use, do I believe that asset's going up in value? If the answer is yes, then financially it's more savvy to borrow against it.
Right. If I were to pursue this route of borrowing on a DeFi platform like Altitude, how would you recommend I think about loan to value? Uh, and how can I kind of like personally make this calculation around how much I should borrow relative to the assets I put in a specific protocol?
Yeah, yeah. Um, so what you want is so there's two ways to think about it. One way is to think, okay, if ETH hits like this specific price level, I'm very happy for my ETH to just be sold off and covered my loan, and I'm done, and I walk away, and that's fine. So that's one way of doing it, saying like, okay, I'm happy to lose my ETH if it hits like 1,000, for example. So then you calculate your loan to value based on that. The other way is where you say, okay, I want to withstand a 80% drop or a 90% drop, and you base your loan to value on that. And when you look at like how the drop that you want to sustain, you can also think about other assets that you have somewhere else. So you could take a loan, and then maybe you've borrowed some, maybe you have some stock somewhere, or you're yield farming with some stables, and then you can basically make a quick calculation and say, okay, I'm borrowing this much. this is how much liquid capital I have somewhere else. I'm therefore willing to take this loan, this kind of loan to value. What we usually recommend people is to kind of go between like 20-30% loan to value, because that means you don't really have to care about the price of your collateral. Like you can sustain a big drop, and then you sleep well at night. And that also gets you the maximum benefit of altitude, because then we will borrow more on your behalf and start to repay the loan.
So how does that how does the yield generating component work? So you mentioned you're borrowing on someone's behalf. How much of the collateral are you utilizing, and are you levering up that collateral?
Yeah. So basically, so we borrow the remaining kind of borrow capacity. So let's say you decide. So one of our vaults is an ETH for a wrapped staked ETH vault, wrapped staked ETH USDC vault that currently has a target loan to value of 60%, meaning that the vault as a whole will borrow at 60%. So if you as a user come in and you borrow at 30% loan to value, then the vault will borrow an additional 30% on your behalf. And at the current market rates, that you pay that kind of amount would accrue 6-7% interest, and we can deploy it at 12, 13, 14% interest. So the kind of the spread we make there, that we use that to reduce the interest on your loan.
When I think about kind of like the liquidation parameters there, is it similar to like one of these typical lenders, or am I taking on the risk of that additional borrow capacity?
Yeah. So it's similar to the other lending providers. So we liquidate the user when the user hits 80%, or we liquidate the wallet when the wallet hits 80% loan to value, and there's a 5% liquidation fee. We are looking into that to see how we can make more soft liquidations, because liquidations is one of those things that like we don't really like, obviously. So the 30% that you borrow, you're responsible for that loan. The 30% we borrow on top, we automatically rebalance as the price of ETH goes up or down. So when the price of ETH goes down, we automatically pull the funds out of the yield farm, and it's used to pay back your loan. So we always keep you at that 60%. So obviously, if the price of ETH drops, that 60% goes up a little bit because of the balance, and then we instantly withdraw from the yield farm and pay it back.
Right.
So and then we basically do that until we are not borrowing anything on your behalf, and from there on, it's your responsibility to look at the loan to value.
I think an important part to understand about this process is that like the loans are also dynamic, right? So
Yeah,
if ETH were to drop 50%, I can also provide additional capital to make sure that my starting capital doesn't get liquidated. So it's not
yeah,
like you know it's not a static asset that I have to just kind of like observe. I can manage my capital effectively and eliminate risk as prices or add risk as prices kind of increase or decrease. So I think
yeah,
that's
yeah.
important to note.
That's a very good point. We have depositors that basically deposit ETH and take a loan, and then don't touch it for 6 months. And we have other people that have literally interacted like 20 times with the vault over the space of 3 months, just to kind of borrow a little bit extra, repay a little bit, borrow a little bit, borrow more, borrow more, borrow more, repay.
That's interesting. You're talking about we're starting to talk about users a little bit, and this is a question I'm very curious about. Who are you building for? Is it an institution? Is it a DeFi native, or is it maybe someone who's more curious about the consumer end of things?
Yeah. Our first target market is crypto natives. And that's because we're like the founding team are crypto natives. So we basically built this for ourselves. We started thinking about this idea about 4 years ago, during the DeFi summer. And this is exactly what we were doing back then. So we had ETH, deposited it, and then borrowed stables from Aave and Compound, and then we deployed them into Curve for the juicy 200% APYs at the time. So we built this basically for ourselves, and that's our first target market. We are focused on kind of the consumer side of things.
I know there's a project called Alchemix that is in a similar vein in this idea of self-repaying loans. How are you guys similar and different to this protocol?
So Alchemix has a cool solution where they use their own stablecoin to basically borrow against. So you deposit your ETH, and then you borrow synthetic ETH, their synthetic ETH, and then if you want, you can sell that for USDC or for any kind of stable. Um, we are much more we're mimicking more the traditional kind of borrowing experience where you deposit ETH, you borrow USDC, and then you're off to the races. And as we talked about earlier, you can kind of deposit more and borrow more, repay your loan. So it's more it's more mimicking that specific experience. And then in kind of how the protocols operate, um, I believe Alchemix is kind of purely on chain, so it's all smart contracts. We use a lot of off-chain automation to keep rebalancing the loan. So as the price of ETH drops, we repay the loan, and as the price of ETH appreciates, we can borrow more. So in a scenario where ETH goes up 20, 30, 40%, without the user having to do anything, you're actually earning more because we keep your loan at the optimal position.
So it's a bit of a more kind of a dynamic approach.
Yeah, and more of a kind of a set and forget approach, I think.
Okay.
So where the user can just kind of they take they take their loan, and then they don't have to think about anything else. So we're earning the yield on their behalf. We're kind of farming airdrops on their behalf. They don't need to worry about any of these things. This all happens in the background. All they see is their interest rate kind of and their loan in there. And then if they borrow at a 20% loan to value, they'll just see their interest rate keeps going down.
So how active is the management of the capital? You mentioned airdrop farming right now. Obviously you guys integrate with all kinds of yield providers. Are you kind of like more of a hedge fund, or are you just kind of depositing into a yield farm and kind of hands off?
Yeah. I guess it's a little bit in between. So we keep up to date with the rates. We do our due diligence, and then based on that, there's an allocation strategy how we kind of allocate the funds to the different farms. So it's not completely passive. It's not like we're day trading. Kind of it's somewhere in the middle.
Okay. When you deposit into farms and when you're trying to generate these yield on different strategies, how do you evaluate the risk of the protocols, and how do you make sure your users are protected and isolated from that?
Yeah, yeah. So first of all, we only deploy in blue chip protocols. And we kind of do our due diligence on all the underlying risks. So we look at the smart contract risks. Have they been audited? How many audits have they done? Has the entire code base been audited by one auditor? Those are some of the kind of the auditing questions. Then we look at the at kind of the stablecoin asset if it's a different stablecoin. So we look at the redemption mechanisms. We look at if there's a secondary market for the stablecoin. Because if there's a secondary market, then we can set up our kind of alerting and automatically pull funds out if the stablecoin depegs. We look at kind of all the risks that are there. We look at how they generate yield. So obviously, there's now a few protocols out there that generate yield through the basis trade. There's yield being generated in different ways. So we look at how they generate yield. Then we usually try and speak with the team. We try and get a sense of what the team what kind of their vision is. We try and look at their legal structure. So we do a bunch of due diligence.
Do you guys kind of view yourselves as like the next generation of borrowing, or are you almost a layer that sits on top of existing borrowing, that's kind of like more advanced and more sophisticated and provides a better end experience for the user?
Um, yeah, we see ourselves as sitting on top of other borrowing protocols because we don't have our own liquidity. So at the moment, for example, the vault is financed through Morpho. So we sit on top of other borrowing protocols, and we try and kind of really simplify the experience for the user. So the user doesn't have to think about kind of moving his loan. The user doesn't have to think about kind of claiming rewards or any of those things. We try and really simplify it for the user.
So there's almost like a TradFi comparison here, where it's like I'm not actively managing my capital. I'm allowing someone who's more sophisticated to manage my capital, and that ends up meaning that I don't have to kind of be worried about the day to day, and I can benefit from the upside.
Yeah, yeah. You can definitely see it like that. And on the other side, we're kind of pure DeFi, where it's all smart contracts, it's all non-custodial, and it's all audited. Um,
And I imagine that that's kind of where you guys are able to make a successful business model. So tell me a little bit about how the protocol itself can sustain itself and make money.
yeah, yeah. So we take a fee on the spread that we generate for the user. So that's simply where the protocol makes its money. So the extra money we earn for the user, we take 25% of that.
So pretty similar to kind of like a other money management models is on
Yeah,
the money you make, you're taking a little bit. Okay,
yeah,
interesting.
yeah. And we deliberately chose to not charge anything on the rest. So on the deposits or on kind of when people borrow. So when they deposit or borrow, that's all kind of completely part of what we do. And then we only make money on the spread.
If you look at a project like Uniswap or even Aave to some extent, in a lot of ways, the ultimate goal of these protocols is kind of to completely decentralize. They are completely crystallized protocols that exist on chain and perhaps can operate with pretty minimal human intervention. You guys are going to always have to work with like the latest yield strategies and always find the best farms and be doing due diligence. Um, is this kind of part of the design, the intrinsic design of the protocol, or is this like a flaw in the decentralization of altitude?
Yeah, 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 yeah. For us, this is a deliberate design, and so what we try to do is kind of almost like the best of both worlds, where everything is fully transparent, non-custodial. It's all like the team basically can't touch your funds, and at the same time, it's an actively managed position. So yeah, it does mean that there always need to be people involved in managing kind of the managing everything. Now, in theory, you could start to decentralize every element of what we just discussed. So in theory, you could have strategists that set the strategies for different vaults. You could have a DAO govern everything, and so in theory, you could completely decentralize. But I personally buy into the ethos of traction first, decentralize later. Um, as long as you have a vision to how you can decentralize.
Hmm. I'd like to talk a little bit more about that vision of the future. So you guys have a fully functioning product. Well, first let's talk about kind of like the existing yield products that people can use right now. So how do you generate yield on people's money right now?
Yeah. So we currently have integrations with Morpho, with Curve, Convex, and Pendle.
And then as far as the vaults themselves.
So there's a bunch on the farming side. So we're integrated with the Gauntlet vaults on Morpho, the Stakehouse vaults, MV Capital vaults, and then specifically the Resolve vaults and the Relent vaults.
Hmm.
And then on Pendle, we're integrated with the Resolve one with the Athena market, and on Curve, it's like kind of more of a generic setup where where we've got to put like 15 or 20 pools that we could deploy into. Um, but yeah, but on Curve, it's kind of almost like an ongoing analysis of the pools, how the pools function.
Okay. What's the future of the protocol look like? How are you guys trying to improve the product and perhaps expand into other products?
Yeah, gotcha. So the biggest thing for us is for the last 6 months we've been whitelist only because we've been in private beta because we really wanted to make sure kind of the product works, the product is safe, and everything kind of works as it should do. We survived kind of the two big volatility events, so in the one in early August and early Feb earlier this month. Those were pretty big things for us. Everything worked very smooth, exactly how it was designed. So that gives us now the confidence to kind of launch kind of an open version. So we'll do that in the next few weeks. We'll launch an open version where you don't need to be whitelisted in order to engage with the protocol. So that's a really big thing for us. And the second big thing is we're launching a BTC vault where people can put their BTC in and then borrow stables.
Are there any constraints around capacity? Because theoretically, the more money that we deposit in a specific vault, the more we're kind of like pulling from the yield of a specific farm. Are there capacity constraints to how much yield can be generated on a specific asset?
Um, I guess the capacity constraint would be the total DeFi capacity. Because ultimately what we do is when people borrow, we pull funds out of the lending protocols and we deploy them into the yield generating protocols. And so we would only be limited by how much those yield protocols could absorb. But it's a great question. That's why we're very picky about which protocols we can deploy in, because protocols that, for example, earn their yield with the basis trade, they've got a certain capacity, which is a large enough capacity.
In the past, in kind of bearish conditions, we've seen yields kind of contract, and it's harder to generate yield on chain. I think some people have a bearish outlook on crypto right now. Is it possible that affects the protocol?
Well, so the cool thing is, so we have been building this for about 3.5, 4 years. So during the bear market, we weren't live, but we were in the market. And so what we saw in the market is that the yields came down, yes, but the borrowing rates also came down. And there was always a spread of like 4, 5, 6% to be made. So I remember the times when you could borrow at like 2.5% against your rep stake ETH. So you borrow at 2.5 and then deploy at like 7, 8%, and you're still making a nice spread. So I think the beauty of the bear market is people don't sell their collateral, right? So they really don't want to sell it. So if they need some liquidity, what do? They will take out a loan against their collateral. So I think both the bear market and bull market has it's different dynamics, but I think in both market circumstances, our protocol has added value.
That's interesting. I never knew that like in bear markets there's more borrowing demand. That's the case.
I don't think that's necessarily more borrowing demand, but because people are not leveraging up usually, or not as much as in during bull market. So I don't think there's a lot of demand from an aggregate point of view, from a total market demand. I don't think that total demand is bigger, but I think from an individual use case where like, okay, now I want to go on holiday, or I want to buy a new car, or I want to buy a house. I'm sitting on these assets. I think they're undervalued. I don't want to. I definitely don't want to sell them. I'm going to wait for another bull run, so I'm going to borrow against them.
Right. Plus, theoretically, it's a better deal to borrow at the bottom when my assets are going to increase tenfold than at the top when my assets are going to fall 90%. So that's it.
This is true, but this is always great in retrospect, right? I mean, they always say like buy when others are fearful, but that's usually the point where most people are actually fearful. So it's quite hard to go against the market. But yeah, I agree. It's great to buy in the bear market.
Right. Yeah. Interesting. Cool. As far as go to market, you mentioned kind of this early whitelist. How's the response been to the product, and how have people been interacting with the vaults in ways that you might have not expected previously, or tell us about this process.
Yeah. So we've got about 50 users at the moment that are using the protocol. And some of them have borrowed large amounts of money to buy a car. Others have borrowed smaller amounts of money to maybe put on a few trades or gamble on a few meme coins. So people use it in different ways.
When you think about the long-term future of the product and the protocol itself, you talked a little bit about decentralization. You talked a little bit about evolutions of products. What are some of the things you're thinking about on the 1 to 5 year horizon?
Yeah. Yeah. So one of the things that we're thinking about is how do we make it easier for more people to interact? So it's a relatively complicated concept, and what we see with users is that there's quite a big hurdle for them to try it, and but once they've tried it, they love it. They're like, "Wow, this is amazing! I see the power now. I still have my asset, and I have a self-repaying loan." So I think we're getting through that with the crypto natives, where people are playing with it. What I would love to see is kind of a broader audience, that we could kind of get a broader audience bought into this. Because every time I talk about this with people that are maybe they have some ETH, they have some BTC, but they're not active in DeFi, they're like, "Oh wow, this is amazing! I want to do it." And then yeah, then you have to go through the steps of, okay, install your browser wallet, and then put some ETH on there, and then you tend to lose kind of a large group of people. So I think that would be really cool if we could open it up to a broader audience.
Right. A lot, there's been a very hot conversation around real world assets, and we've been slowly seeing the adoption and the industry kind of adapting to real world assets coming on chain. Do you think that that's a space that you guys are curious about, or are you mostly sticking to like digitally native assets right now?
Yeah, no, 100%. I think real world assets are very interesting to borrow against. It's also something that many more people are used to, right? So we're looking at, for example, tokenized gold. That would be a really interesting one. I would personally love it. I don't to do like a tokenized S&P 500 or a Nasdaq and borrow against that. We're not there yet as a space, I think, or at least I've seen the first kind of small steps. I don't think it's mainstream yet, but I think that could be really interesting. That you have more the assets that a lot of people are already holding, that you can borrow against those, and it's exactly the same dynamics.
Right. I mean, for me as a consumer, it's a lot more compelling to me to borrow against the S&P 500 than ETH because like these digital assets are kind of like intrinsically hyper volatile, which makes
Yeah,
borrowing a riskier prospect. So
yeah,
borrowing against less volatile assets. Obviously the yield bearing asset has an attractive component to me, but that's like the scariest part if I were to borrow against my ETH holdings, is you don't want to get liquidated on your
yeah,
ETH holdings or something. So
yeah,
it's a tricky thing.
yeah. I mean, that would be super exciting if we can do that. But there's a few steps in between that we have to take to enable that. But yeah, that's kind of the big dream.
Hmm. What's your greatest ambition with the protocol? If you were to step back in 10 years and look at what you've built, what would you deem success? Is it a TVL? Is it an amount of users?
Yeah, it's a good question. Um, I mean, ultimately, you want to provide value to the users, and the way that they express that they're getting value out of the protocol is by letting you manage their assets or having their assets in your protocol. So I think kind of AUM, TVL, I think, or so assets under management or total value locked. I think that's a great kind of proxy for how much impact you have as a financial product. So if you look at kind of, I don't know, if you look at Facebook, they've got billions of users. I think with the financial product, the best way that it's expressed is that you have billions under management, or tens of billions or hundreds of billions.
That's really an ambitious goal, right? To say, to even consider the fact that hundreds of billions of dollars could be borrowed against in or utilized in your protocol someday, when the total crypto market cap, is probably, I think, somewhere around 2.5 trillion dollars right now.
Yeah.
But it seems like despite 4 years of building and a lot of it in difficult market conditions, including now, you're still optimistic. What would you say to people who are a little bit jaded by the crypto space right now?
Um, I guess I'd say just kind of try and zoom out, because in the crypto space it's very easy to get kind of to get sucked into the day to day, or the week to week in the price movements. If you zoom out and if you see where the crypto space has come from, and if you then zoom out and think like, okay, would the financial world be a better place if everything was tokenized? I believe so. So, and I think from there, like if you zoom out far enough, it's a direct line straight up and to the right. Um, if you zoom in on a daily or on a weekly basis, yeah, it's messy. So I think that's what I would say. Like, take a little bit of a break, zoom out, switch off X for a while, and then come back with new energy.
Well, I think that's really the trickiest part of crypto right now is like, yes, if we zoom out on the broadest time frame, then it's easy to see the bullishness and the trend upwards. However, in the day to day, in the so-called trenches, there are kind of reasons to be pessimistic, and when you look at specifically a protocol like yours where it's focusing on the evolution, the 1 to 10 instead of the 0 to 1, it's hard to see those incremental improvements, right? That 1% improvement every day in user experience, or generating a little more yield, or being able to cut costs or decentralize a little bit more. And it's hard to see that in the day to day. And I think that's what's perhaps frustrating to people in crypto is people want it all now, and they want it fast.
Yeah,
And it if you're not willing to look out on that long time frame, it becomes frustrating, or pessimistic. It creates a pessimistic outlook. But that's an awesome
for sure.
perspective, and I really appreciate it. Throughout your founding journey, if you had to give one piece of advice to other founders in the DeFi space or in the crypto space at large, what would you say?
Um, Make a product that people want, and that people once they use it, that they love it. Everything else will follow.
Excellent. I think that's a great note to wrap things up on. We really appreciate your time here today. Where can people check out your product and what you have in the pipeline?
Yeah. So kind of our main channel is X. So go to x.com/altitude fi underscore. And then from there on, there's links to our Discord, to our Telegram group, and obviously our website, altitude.fi.
Phenomenal. Awesome. Thanks so much for your time,
Cool.
and we look forward
Yeah,
to
thanks, Jack.
seeing the progress of your product. So
Awesome.
we'll be
Thanks a
paying
lot, Jack.
attention. Thank
Appreciate
you.
it.